Right now, a coalition of nations representing almost half the world's population is quietly building an escape hatch. They are constructing an alternative financial network explicitly designed to route around the United States dollar. To understand why they are building this, we have to look back to how the dollar secured its monopoly in the first place, starting in 1944 at the Bretton Woods Conference. This diagram illustrates the mechanical blueprint established at that conference. The agreement was simple but incredibly powerful. Every global currency would tether directly to the US dollar, while the dollar alone would be pegged to physical gold. American negotiators had the physical gold, the intact industrial base, and the military power. They designed a deliberate system that ensured global trade would flow strictly through their currency. Economists call the result exorbitant privilege. When Indonesia buys rice from Thailand, or a Brazilian bank lends to an Argentine company, the deal clears in dollars. The United States can simply print the currency that the entire world is forced to use for its international contracts. Because those contracts are written in dollars, almost all cross-border transactions have to clear through Western financial institutions and a messaging system called SWIFT, which is heavily influenced by Washington. In 2022, the United States weaponized that exact plumbing. Following the invasion of Ukraine, Washington and its allies instantly froze $300 billion in Russian central bank reserves. Money that was supposedly safely stored in Western banks became entirely inaccessible overnight. Every non-Western government immediately recognized the danger. If you keep your wealth inside American-controlled financial infrastructure, Washington has the power to erase it. That realization accelerated the expansion of the BRICS coalition. Originally 5 nations, the bloc has expanded across the Middle East and Africa, shifting from simple bilateral trade agreements to constructing entirely parallel financial networks. This flowchart compares the legacy network with the new alternatives. On the left, the standard SWIFT route requires data to pass through Western nodes. On the right, China's CIPS and Russia's SPFS messaging systems are specifically built to replicate SWIFT's function, while keeping the communication data entirely off American servers. We also see a shift in how the money itself settles. Instead of relying on a dollar intermediary, the BRICS-supported mBridge platform uses central bank digital currencies, national electronic money, allowing member nations to instantly clear trades directly with each other. This bypass is already operating at scale. Russia and China currently settle roughly 90% of their bilateral trade using strictly rubles and yuan. The nations involved are executing a mechanical, infrastructure-level separation from the U.S. financial system. While they build the digital plumbing, these same central banks are hoarding physical assets at a historic volume. For 3 consecutive years, central banks have purchased over 1,000 tons of gold annually, more than double the average of the prior decade. Gold serves as the ultimate decentralized shield. It is a physical bearer asset that operates completely outside of digital banking ledgers. The U.S. Treasury cannot freeze a gold bar sitting in a foreign vault. Acquiring these massive gold reserves is a mandatory step before the BRICS nations can attempt to launch their proposed unit, a highly discussed new reserve currency that would rely on commodities for its backing, rather than American promises. Yet, pulling the global economy off an 80-year-old network is incredibly difficult. Look at this chart. Despite the expanding BRICS bypass, it shows that recently, the US dollar remained on one side of nearly 90% of all global foreign exchange transactions. Its market share actually increased. The primary alternative, the Chinese yuan, suffers from a fatal structural flaw. Beijing maintains strict capital controls, restricting how money moves in and out of its economy. A currency cannot become a true global reserve asset if international investors are not allowed to freely convert and trade it. The BRICS coalition also faces deep internal geopolitical friction. India, for example, maintains massive economic ties to Western markets and has explicitly stated it has no policy or desire to replace the dollar. Any attempt to force a new currency will face an aggressive U.S. counteroffensive. The incoming U.S. administration has threatened to impose 100% tariffs on any nation that attempts to create a rival reserve asset. The blueprints for a financial bypass exist, but migrating away from the dollar monopoly is a highly vulnerable, fragmented process. The dollar isn't facing a sudden collapse. To understand what happens next, we have to look at the historical template of the British pound. This chart traces the pound's global reserve share. It didn't crash overnight. Instead, from 1948 to 1980, it experienced a slow, grinding 30-year downward curve, driven by a steady loss of trust and utility. The global economy is entering an era of financial multipolarity. The US dollar will likely remain the largest single player, but it will operate within a shrinking kingdom as regional payment bypasses handle a larger share of the world's trade. This slow erosion carries direct domestic consequences. A structural drop in global demand for US debt means the American government has to offer higher interest rates to sell its bonds. Those higher rates inevitably bleed into the wider economy, raising the cost of mortgages, hiking rates on credit cards and auto loans for ordinary citizens. For the investment landscape, physical gold is cementing its role as a permanent systemic hedge, while the alternative payment networks being built across the global south represent critical new growth infrastructure. The ultimate catalyst to watch involves the energy markets. If Saudi Arabia permanently decides to price its vast oil exports in a currency other than the dollar, the slow erosion we are seeing today will sharply accelerate. The monolithic financial architecture engineered at Bretton Woods is actively fracturing. The nations that were excluded from its design 80 years ago are now actively building the future of global wealth.